Hey everyone, my name is Jack, and in this video I want to go over the very savvy move made by hedge fund manager Ray Dalio all the way back in November 2019 and how it is paying him now despite the terrible market that we are facing at the moment. Before we move any further, I have to emphasize that I am not a financial advisor and this video should not be taken as financial advice. This is just going over the strategy that some investors have used with some success in the past. I'm just some guy. Leave a like though. For those of you who don't know, Ray Dalio is a billionaire who runs the largest hedge fund in the world, Bridgewater Associates, which famously performed very well during the 2008 financial crisis. Bridgewater holds $150 billion or so in assets. More recently, in November 2019, Dalio and Bridgewater bought $1.5 billion in put options against some major indices tracking the S&P 500 mainly. An option is the right, but not the obligation, to buy a stock at a certain price in the future. For example, if a stock is trading at $100 per share right now, and I buy an option to purchase that stock at $95 per share, and that option expires 6 months from now, and I only make money if that stock goes down in value, then I have just opened up a put option position. I will only be able to use this option if the stock drops below $95 per share before the end of the 6-month expiration period. If it doesn't reach that price, then my option expires worthless. Call options are the exact opposite. They only work if a stock goes up in value, and then your option will be able to be used so you can buy the share for less than the actual share price. But if the stock doesn't go up in value, then a call option also can expire without any value. The options contracts are tradable as well. These contracts give you the right to purchase 100 shares of those stocks at the underlying price designated by the option contract within a particular time frame. Contract values swing up and down with way more volatility than the stock market. And you can actually think of the options market like a sort of stock market on steroids with drastically higher risk, but also drastically higher potential for reward as well. Ray Dalio's fund bought a massive amount of put options in November that were set to expire in March 2020. They generally required about a 5% drop in the market's prices to be executed. That means if the market did not drop by about 5% before the March expiration dates, the options would become worthless by the time they expired. The $1.5 billion in puts represented about 1% of the Bridgewater portfolio at the time. Ray Dalio and the Bridgewater team believed that there may have been a correction coming in the market, so they bought what essentially is an insurance policy to protect their otherwise optimistic and aggressive holdings. This meant that they were protecting against downside loss at the expense of the potential for future profits, assuming times remain good. And this is not uncommon for hedge funds to do, which partly explains their name, hedge funds. Fast forward to today, and wow, did he make a good call, or I should say a put. Anyways, March 2020 has marked one of the worst stock market drops in its history. From the end of November 2019, when Dalio's fund bought the put options in the first place, the S&P 500 dropped 5% by March 1st, 2020, and continued to drop rapidly after that, reaching a 20% drop by the end of the second week of March. Even as the rest of their portfolio drops with the market chaos, their put options have likely saved them from an enormous amount of losses. Bridgewater has reported mixed results in their funds as of March 2020, but they are comparatively modest compared to the rest of the market. And granted, they do have a lot of longer-term bond holdings in their portfolio, but Dalio and Bridgewater still have prevented themselves from facing a lot of the same losses that so many other people have faced in the market in 2020. Even if the put option strategy did not work and all of these options expired without any value because the market just kept going up the entire time, we would still expect Bridgewater to be doing quite well since 99% of their holdings were in things besides these put options. In short, using put options as a sort of insurance policy is a great way to hedge against potential risks in the short, medium, and even long term, depending on how the strategy is used. On a similar note, Ray Dalio definitely believes that these insurers against these options are in pretty big trouble. In a LinkedIn article from March 3rd, he described what's going on right now as one of those once in 100 years catastrophic events that annihilates those who provide insurance against it and those who don't take insurance to protect themselves against it. After all, someone has to pay out these options, And often many funds will sell these contracts without being able to cash out on them because of liquidity issues. The people on the other side of these otherwise lucrative options contracts are probably in for a world of hurt. In the meantime, we always have to be prepared for the worst, but we have to keep our eyes on everything in the meantime, the short, the medium, and the long term alike. And looking at what successful investors have done and taking a look at their strategies can be an effective way to remind ourselves of just that. Anyways, that's all I've got today. If you like this video, be sure to give it a like as it helps the channel out a lot. If you like this sort of content about investment and investment strategies, let me know in the comments below. And if you don't want to miss any updates, be sure to subscribe. I post new content every single week about investment, real estate, and other personal finance topics, and I don't want you to miss any of them. I'll actually be posting my monthly update about the M1 Finance portfolio I'm building, so be sure to stay tuned for that. Until next time, take care.